Let's go ahead. Hi,
Recording in progress.
good morning, everyone. On behalf of Axis Mutual Fund, this is Raghav Iyengar here. Welcome you to a very, I hope, what will be an interesting session for all of you. I am the Chief Business Officer, as you can see from the slide of Axis. I'm a chartered accountant by qualification. I have been in the industry now for 20 plus years, and trust me, it's been a very, very exciting journey. One thing about this field that I have chosen is that life is it changes very fast, right? And I think the only thing in this industry or in markets today is change, and anticipating and then obviously reacting to that change is what makes my job real fun. Uh, I'm really happy to see we have a huge number of people on this call. I'd like to thank you for taking your weekend time off. Obviously, it's a Saturday morning. People think that most of us are sitting at home and generally avoiding the commute, which is good. But I think the other flip side of that is that I think work hours have become much longer, much heavier, and obviously for many homemakers, managing work as well as home is a bit stressful. Sometimes I think I hear many of my colleagues actually telling me that they're really waiting to get back to office, which is pretty different from what it was, say, 2 years back when people would actually be waiting to go home. But on that note, I mean, we are in a very interesting setup for the market today. I don't know if you read this book, A Tale of Two Cities by Charles Dickens, but it starts with a line saying that we are in the best of times and we are in the worst of times, and that's to some extent that's what's happening today. So if you were to open the financial newspaper today and look at, say, Economic Times headline, you will see a number which says that the Nifty reached its highest ever level in history briefly yesterday, and of course, then it went down a little bit after that. But if you read a local newspaper, you will suddenly see 175,000 cases, unfortunately 4,000 people or 3,500 people losing their life. And many of us, me included, are sometimes a little bewildered with what is this, a tale of two cities or a tale of two headlines. How can you have a market index, which is ultimately a representation of our company's economies or a country's economies doing, being at at a different level, and the real picture on the ground where you have, India is even today having the largest number of cases in the world. How can that be? How do you reconcile that? And through today's session, over the next 15, 20 minutes, my plan is to just try and provide you with a little bit of understanding of what we think is possibly causing that. And then more importantly, what we think will happen over the next 1.5 years, at least for the near term that we can count. And then obviously talk about a very interesting idea, which is as old as investing itself, which is asset allocation. To my mind, that is been my peace of mind mantra. Personally, I've been a mutual fund investor for more than, like I said, 2 decades of my life. It's been a very fruitful experience. At times, very stressful because, and that's where I found asset allocation has helped me personally to take that stress, ease that stress off a little bit. At the same time, ensuring that I reach my goals for what I'd kept my money for. Can we go to the next slide, please? We are also making this a little more interactive. I think you would have seen a quiz before I started speaking. And that's largely to get your sense of what's happening, what do you feel about various things that we have put up. It's a very small thing, just about 4 questions. We do have a lot of questions that have already come to us, so I'll try and answer that during the course of my conversation. But yes, in case I miss out something, we do have a short Q&A session at the end of this session. I promise you, like how we started bang on time, 10:30 we were on. I will make sure that we finish by 11:30. I deliberately put my email in front. I don't know if any of you caught it, but it's rhav.iyengar@axismf.com. And I'm really love to hear from you. There are many things that I cannot talk about, or many things I can't write about because of the way our industry is. But yes, basic stuff. I love to hear from you. Anything, direct communication with you is always fruitful. So coming to what happened, I mean, and it's lovely to talk about what happened because you know exactly what happened, right? it's the past. So we can just change the English a bit. But the fact is that the last 15 months have been possibly amongst the most trying for humankind in this century. Out of nowhere, a small little virus came. Most people ignored it, thinking it was a common cold, virus, flu, which all of us, especially in India, are very, very used to. It's a regular feature of our health. Monsoons come, weather changes happen quite frequently. We do fall sick, right? And we fall sick for a few days. We go to our doctor, we get a little bit of medicine, maybe some antibiotics, told to take some rest, relax for a couple of days, and hey presto, third, fourth day you're back. Unfortunately, this is not the case in this time. I mean, you had a serious global crisis, which is yet mutating now. I mean, we are now into all kinds of letters, and I've lost count of the number of variations: South African variant, Brazil variant, UK variant, India variant, Maharashtra variant. So there's just so much of stuff happening. So but what was interesting is that the way the global markets coordinated, and we also did the same thing. So RBI, Reserve Bank of India, really lightened up, really got into the act because they're the ones who have the heavy machinery, right, to prevent a systemic collapse because of this. Because on one side you had the government which just didn't know what to do at that point of time. The uh, the fatalities, if you remember in March, coming out of China were very, very scary. We had a death rate in excess of 8-10%. And given our large population, they closed down. But after that, I think when the economy opened up, and if you see in about 4 or 5 months, I think economic activity came back and finally culminated in what is called a very, very growth oriented, very different budget on Feb 1st. So we started with despondency in the early part of 2020, and we ended 2020 on a pretty much of a high. So if someone had actually gone to sleep and got up after a year, he would have not realized what happened. Somebody say went to sleep in December 19 and got up in say Jan 21. When he looked at markets, it's actually would have looked much, much better. And the same thing happened to fixed income too, because you had the Reserve Bank coming and putting in so much money. What happened in the second wave? Because the writing is yet out, the jury is yet out to try and determine what's happening there. But maybe we've all let our guard down a little bit. As we are, man is a social animal. You can't keep us closed down for a long period of time. So obviously, when the curbs, the restrictions, and all that sort of went away, we did get a bit relaxed about it. We maybe let our health guard down, and at the same time, we were not fully vaccinated. So we had a second wave of COVID, which is unfortunately yet raging as I'm speaking to you. I mean, 175,000 cases is yet almost double the peak of what was there in COVID 1. So it's not that we are over the hill. Yes, we are far better than what we were in, let us say, the second week of April. But having said that, I think we yet need to be very, very careful even today. Obviously, when markets are creatures of uncertainty, like in anything else, markets also get very, very volatile. So obviously, as the uncertainty grew, markets go even more volatile because obviously you ultimately what is the equity market or the fixed income market? They are a barometer of the economy. So when something uncertain is happening to the economy, the markets tend to get very, very choppy. That is what has happened in the last month and a half, right? Uh, the good thing from COVID 1 to COVID 2, the second wave as we call it, is that we do have a vaccine, or we have many now, actually, which are now tried and tested. And yes, there have been some side effects, but largely they have been very, very positive. And that ramp up is happening. So today people are looking at how the vaccine numbers are. And I have a small slide at the end of it. And I think it's very, very important for us to sort of, talk about that because ultimately the markets are going to be judging the way, the things are that time, depending on the vaccine. Next slide, please. Sorry. Yeah. So I think if you compare, I mean, and this is just a quick snapshot of what I've just talked about. But yes, I think the big thing, if you remember in the first wave, was that economic activity completely slowed. I mean, it's just completely halted. Right? There was nothing happening. I mean, I live in Bombay, and if I looked out of my window at that time, it felt as if we were in a ghost town. There was not even a single person on the road. Construction activity was stopped. You had grocery shops open for a couple of hours, and the only activity was this huge line of people standing outside various grocery shops and stuff. But everything else was shut. No traffic, nothing else. I mean, obviously, no entertainment, nothing. But this time, what's happened is there's been a slowdown. So obviously, high risk things like entertainment, maybe restaurants, sports events, those have obviously got curtailed, clubs, gymkhanas, all that is gone. But basic economic activity is yet continuing and continuing quite well. How do we track that? If you go to the last point, you will see a small point called GST collection. Obviously, when there is no economic activity, obviously, where is the tax to be collected? But this time, if you see what's happened, uh, the GST numbers have been quite resilient. Yes, I mean, many people tell us, and that's a partially true, is that yes, we are in a way, in some sense, the backlog of maybe the last 2, 3, 4 months is also hitting us. But yes, having said that, it's not gone from, let's say, in the end of February, it was close to about 90,000 crores of collection of tax. In the end of March, that number had come down to four figures. Uh, that's not the case. In fact, actually, it's gone up. So that's just telling us that there has been a bit of a slowdown. Of course, now whether the slowdown gets better or gets worse is something that we will talk about in the next slide. So I think if you look at it, people have asked us that what do you think has happened, and I think the broader market, which is, if you ask me today, the B2B market, like an iron and steel or a technology, these are companies that are doing very, very well. What has possibly got affected is what we call the B2C, which is, let's say, FMCG, to some extent financial services, where there is a direct touch of the company to a customer. That activity is obviously reduced. But unlike the first wave, the key word here is reduced, not stopped. Right? Can we go to the next slide, please? So some of the favorable factors is what's happening around the world. India is, of course, as you know, now very, very plugged into the global economy. We have a very booming exports, not only of software, but of various other things, including agricultural commodities, metals, steel, manufacturing, a lot of stuff today. Of course, we are not what we are. We are not yet today the factory of the world like China is. But having said that, there's a huge amount of exports that we do. And if you remember the first wave, there was the Western world was actually more decimated than even India. In this, if you remember, the April to maybe June, July period was when global economies actually went for a complete toss. And that's not happening today. So what we're seeing today is, and that's possibly an impact of the vaccination, the impact of them having 3 or 4 waves already. Japan, for example, is already into its fifth wave. And more importantly, how do we, so as long as global economies are doing well, you will find that uh, the chances of economic recovery in India are far, far superior. And that is where some of our export sectors and things like metals and stuff like that have done really well, despite the second wave really hitting us much worse than the first one. Yeah, next, please. Hari, next slide, please. Thank you. This is again just a pictorial representation of what I spoke about in the previous slide. I mean, if you see, e-way bills are a very good way to track uh, economy movement, right? How, and if you remember, if you just go to the first point, I mean, and I'm looking at, the first bar was actually last year at this time, if you remember, in March, April, and you look at that, it has just completely crashed. But you look at what's happening today between, for example, March and April, there is a fall, but it's not like a complete drop, unlike last year. And the same thing you can see, for example, on the left-hand side in terms of the right-hand side chart in terms of steel, tractors, two-wheelers. They're practically almost at back to pre-COVID levels, which is that the economy as it was, let's say, in January, February of 2020. So just to try and tell you that why markets are in a different world, right? I mean, for us, we are creatures of the news. We look at our community problems, we look at our city, we look at our district, and we say, hey, these things are so bad. So if I was, let's say hypothetically in Bangalore today, I would be wondering, we're yet having 5,000, 6,000 cases a day. The number of cases that just increased. These slides are just to reinforce the fact that, maybe yes, there is a challenge in Bangalore, but the economy is not doing as badly as what maybe a Bangalorean is thinking it is. And that's what the market is actually doing today and taking that into account. Okay. Next, please. Uh, I think this is the big one for us. I mean, in the sense that if you see the vehicle registration, which is like a big, big indicator for us, is actually almost back to pre-COVID levels. And you look at that big drop that happened last year, and you will understand what I'm coming from. Yeah, next, please. I think the big one here again is in terms of the infection, if you remember last year, was very much a top six city phenomenon, if I may use that term. And the top six or top eight cities, which is typically Bombay, Delhi, Bangalore, Chennai, Hyderabad, Pune, Ahmedabad, these are big contributors to consumption and consequently to growth in the economy, right? And these, if you remember, in the COVID one phase, were the ones that got hit the most. Of course, they got hit even today. But today, if you look at the large parts of our COVID cases are also coming from, unfortunately, from rural areas, which is heartbreaking from a calamity perspective, but from an economic perspective, it's not that significant. And that's another thing that the markets are looking. Lastly, I think if you look at, I think in terms of vaccines versus fatalities, if you look at that, the fatalities are actually almost a straight line on the bottom, and the vaccine actually has actually gone up. So today you have almost about 40% of 35% of the American population fully vaccinated, almost 50% of the UK population fully vaccinated. Large parts of India are slowly getting it done. So today, I think there seems to be, at least thanks to the vaccine, a possible end to this whole uh, pandemic that we have seen in the last 15, 16 months. Yeah. Next slide, please. So I think this is again a very detailed chart of how we expect the vaccine supply to improve. I think obviously it's very technical, but those graphs are just to show that where we had only one or two suppliers in the beginning of the year, that number is actually going to go up to about 5 to 6. And almost every day, new vaccines are getting approved by our medical authorities. And people were very worried about the pace of vaccination. But just to give you yesterday's count, and I watched that number very carefully personally, because for me that's also makes me feel happy. It's a well-being number for me. So yesterday's vaccination count was 28 lakhs. It's 2.8 million, which is exactly the number which was predicted, if you remember, in this by this chart. And we have moved from about 1.4 last week to about 2.8 right now already. And I think the way things are with vaccine supply ramping up, with obviously new vaccines coming in, I think there's a very good chance that we'll get to this 14, which is about 1.4, 1.5 crore per people per day. The second thing one must understand is that in the initial stages, when the vaccine got rolled out, there was a lot of skepticism about the vaccine, because obviously we are also unfortunately creatures of social media. Social media, a lot of stuff that comes out is good, but a lot of it is also fake news. And a large part of it which was coming out was the fact that these vaccines are actually creating a very negative impact on health, and actually not curing people, which frankly has now, after the last 5 6 months of vaccine, especially seeing that the Western countries have much better tabulated results. They've sort of seen the impact. They've seen what are the side effects. And now the number of people actually looking forward to getting the vaccine is far higher than maybe sometime in the month of March, where actually people are very worried that should they take the vaccine. So I think there are two things to it. One is obviously the number of people wanting to take it, which is very good today. It's very high. Most people want to do it. Yes, there is a slight challenge in some rural areas, but I'm sure with our social system, with our NGOs, and with the local community working, we will cross that. The second part, of course, was the fact that there was a big shortage of vaccines, where we are going through all this stuff, and a lot of jokes in the again in WhatsApp about it being a fastest finger first and things getting over and things like that. But if you see, the graph is definitely increasing. So if this happens, I think we will be in a far better situation than we were maybe in COVID-1. And if we are able to hit these numbers, we will have a fair percentage of our population vaccinated by end of this calendar year. I'm talking December. And if that happens, the chances of having a second wave is or a third wave or a fourth wave diminishes by that much, because it's very clearly been proved that if you're able to vaccinate significant part of your population, the chances of a fresh large outbreak diminish much easier. So yes, this is a number that we must track. And for people who have not done their vaccination, I've already got my first shot. I have many colleagues, friends, family who got their first and second shots, and trust me, they're all doing very well. So uh, I'm like a living batra in front of you. No side effects. Yes, a little bit of fever, a little bit of weakness, but apart from that, I haven't heard of anything significant in my extended friend, investor, well-wisher circle. Yeah, next slide, please. So I think the good thing is that yes, RBI, the Reserve Bank, and the government are actually marching lockstep. That means that both are actually pretty much coordinated, which has been an issue in the past, but at least this time in the pandemic, it is not there. So I think there's going to be a lot of monetary, which is a lot of RBI giving you a lot of liquidity, giving you many growth measures. At the same time, you're going to have a lot of fiscal. Fiscal is what the government of India does, right? Monetary is what the RBI does. So fiscal, the big thing that is there now is, for example, is being talked about is PLI. PLI is nothing but production-linked incentive. So you make a certain amount of a certain product, let's say mobile phones, the government gives you a little bit of incentive to do it. It is something like our bonuses, right? If we work very hard and we reach our target, or we make a certain amount of profit, or we make a certain amount of sale, the company gives you a little bit of extra money called bonus, right? And that is similar to what is PLI in a very simplistic manner. Of course, it's much more complicated than what I'm making it out to be. But if you look at these charts on the both on the side, what you must notice is that big fall on the, I mean, that big, almost like a 90-degree vertical rise. And that's actually really contributing to our GDP growth. Quick 2 minutes, quick 10 minutes. Hurry, next slide, please. Next two slides. Just a quick 2 minutes on the fixed income. Fixed income is debt. Obviously, a lot of you are not debt investors. If you are not, I would really recommend that you be, because having exposure to debt and equity actually balance out to your portfolio. It's actually the cornerstone of asset allocation, which we'll be talking about in a few minutes, right? So if you ask me today, what did the RBI do? They gave a lot of. So when the economy collapses, what tends to happen is that everybody gets into a worry. Lenders who are very important in the system, because they are the ones who provide credit. Credit is what makes the economy go around. In some sense, it is like the blood in our system. It makes sure that that the economy is functioning and working very smoothly. But when something seizes up, or when you have a chaotic event like what happened last year, the first thing that happens is most creditors tend to immediately walk away from giving fresh credit out. Obviously, because they are worried, because their job and their profits, and obviously their job is to ensure that whatever money they give out comes back on time, right? And obviously, in a time of crisis, that equation is not very clear. So RBI came in and really ensured that credit availability was made sure. Because then RBI said, hey, if you give credit out, I'm willing to refund you, or I'm willing to give you some concessions. And even today, they're doing a lot of that. And they did something called targeted lending, because they figured out that parts of the economy which needed credit were not getting it. So they came up with a set of programs which actually ensured that those set of people who really needed the money actually got it. And finally, of course, I think this thing really worked. Obviously, we've seen what's happened to economy in the previous 3-4 slides. I've shown you that vertical uptick. A large part of that is actually has happened because of RBI really taking a huge amount of proactive action over there, right? So what happens to RBI? I mean, you can't have this. It's something like, obviously you, and if I were to look at it as a medical term, patient is obviously not well, he's in ICU, you start feeding him huge amounts of medicine, really strong medicine, and that's what the RBI did. Now the patient is fine. If you look at the economy as a patient, actually the patient has made a remarkable recovery last year, right? I mean, he went straight from ICU to normal to now he's actually running. In fact, in many cases, we are almost back to, or we are got back our functionality what we were maybe before this thing started. So I think the key thing there is that RBI stepped up, and I think now they're slowly, next slide, please, right? And now they're slowly taking that extra medicine out of the system. So the medicine is in the form of liquidity, which is excess cash. They're trying to raise interest rates quietly, because I think many of the rates have fallen below what we call the RBI normal rates of 3.35 to 4%. They're trying to take that up a little bit, and obviously trying to normalize rates and getting things back to normal, right? Yeah, next slide, please. So I think the good thing, if I were to look at, and people ask me, hey, in 2013, the US also started cutting back. And this is what RBI has done, is actually been done pretty much by most of the central banks across the world. And obviously, everybody will have their set of medicines which they need to slowly take out of the system. So if you remember in 2013, a very big event happened, which is called the Taper Tantrum. And that was because the US started withdrawing some of the stimulus that they had built up in post the global financial crisis in 2008 and 9. But at that point of time, our foreign reserves were very less. Today, actually, we are at record reserves. I mean, yesterday, we closed at about $592 billion. It's almost like 4 times what it was, much more, sorry, than what it was in 2013. So what it does is that it gives us the ability to absorb any shock very comfortably, right? So I think slowly you will see, obviously, FI flows obviously have moderated. They will come, but I think today a lot of the local economies actually sort of starting to gear back again. Next slide. So of course, what are the risks? I've given you all the great things. I think the key things are, of course, is that global interest rates. And now you'll be wondering that why do global interest rates affect India? Because ultimately, what happens in the US, what happens in, let's say, Europe, why should it bother me? But money flow tends to flow according to a set of rules. And one of the rules is that if interest rates go up, many of the countries which actually are driving up interest rates actually see a flow of capital coming back. Slightly longer topic, maybe we should talk about it at a second session, but that's one. And of course, India is, as you know, a net importer. So obviously, if commodity prices, namely oil, etc., continue to go up, inflation goes up. If inflation goes up, there's a good chance that RBI may be having to, it will create issues in terms of the way we are, uh, the way we invest, and more importantly, the way companies react. So these are two risks that you must sort of keep in mind, especially on the fixed income market, right? Uh, the good thing is that, yeah, there are a set of lot of favorable factors, very good liquidity, uh, very strong forex reserves, and a very proactive central bank who's really looking at data very, very actively and taking immediate measures. These factors are, of course, something which is not very much in our control, which is rising commodity prices, which frankly is happening today because China is really buying out and driving commodity prices up. US recovery is great from an Indian perspective, but in the short term, it could lead to some volatility, especially in fixed income, because rates may go up. And of course, you could have also a global recovery, which will make India, in that sense, a little less attractive destination than what it was, say, last year, when large parts of the world were in negative growth and we were yet looking to show almost double-digit growth in that. Yeah, next slide. So I think some of the things that we can talk about in fixed income, I think obviously you can invest in long-term debt. You can look at, because on a 3-year basis, I think long-term debt yet looks reasonably attractive. The rates are real rates, which is basically your rate of return minus inflation is yet positive, which is a very good indicator of putting money into long-term. You can take a call on credits because as the economy gets better, economic activity picks up. Many balance sheets which were looking weak start getting much better. Case in point is, let's say, the metal sector, which was looking very weak 2 years back, but now has made a very, very rapid turnaround. And of course, you have the theme around reinvestment, because as rates keep going up, if you are in very, very short-term uh, instruments or short-term schemes, as and when the rates go up, it gets repriced higher and higher and higher. So you, over a period of time, you make a slightly better return than what you would make today. Yeah, next slide, please. So I think, yes, my last slide on market. I'm sorry, I've taken a little longer than what I wanted to do. But yes, today I think equity is obviously at this point of time in a new high. Market is always in that sense a bit, and I use the example, and a friend of mine actually posted it, like a person and his dog going for a walk in the park, right? And when he gets to the park, he leaves the dog loose. It's a well-trained dog, and the dog keeps going here and there. But eventually, at the end of the park, at the end of the other side, on the other side of the gate, they again meet up. The market is like that. The economy is the guy, and the market is a bit of the dog. So the dog will keep going up and down, backward, sideways, here, there, everywhere. But ultimately, if the economy gets to where it is, which is the other side, I think the market will reflect that. And that's the beauty of equity, right? So I think today, yes, there is some sector rotation. You're seeing, as I said, B2B names have, B2C names have actually not done too well. B2B names like metals, chemicals have all done reasonably well, will continue to do well in the global recovery if that continues. You have obviously developed markets reporting very good activity, which is very good from, let us say, the technology standpoint. You have the pharma sector doing well, obviously, because of the whole pandemic and all the stuff that will get built around it. So I think my suggestion is that, yes, I think investors should stay the course. I don't think you should take it out. I don't think you should worry about what's going to happen next year, because just whenever it's very, very difficult to predict after 1 year, because you're not, the markets really don't care about 1 year, 2 year, 3 year. We do, right? But the typical thing in equities is that, yeah, the longer the investment horizon, the less riskier equity tends to be. That's the general experience, not only in India but across the world. Similar, I think, in fixed income. I think, as I said, RBI is very, very proactive right now. I think they will keep watching economic data. We don't expect them to do something drastic. Of course, key risks over there are obviously global commodities going up, global inputs going up, which could lead to inflation, which could lead to a change in interest rate. So yes, there are a lot of things to do there. Buy some credit funds, keep some money in short-term funds, keep some money in ultra short-term funds, or typically buy long-term funds also, which are also good, give you a very good carry today in today's interest rate environment. Uh, Most of us actually tend to absorb this information, but it's a little heavy for all of us, me included. Even though I'm an active participant, one of the best parts of my job is to be looking at this every day. But I think the beauty of in the Indian space is that there is a solution. It's not Indians, it's across, and there's a solution called asset allocation. And asset allocation is nothing but putting money into different asset classes depending on your risk appetite, on your circumstances, and why it's important, how to do it, and more importantly, what you should be doing is something that I have a colleague, a very esteemed colleague of mine, Hari. Hari looks after our training and L&D. In fact, he's the only one in Access who's actually written a book. It's called Money Muni. So whenever you guys get some time, you should have a glance through it. It's very, very simple. On the topic of asset allocation, I think Hari is pretty much done some interesting stuff. And Hari, I'd like to turn this conversation to you. And yes, of course, we will take questions at the end of Hari's session. Yes, over to you.
Yeah, thank you, sir. Good morning, everyone. Namaste, namaskar. Welcome all of you to this part 2 of the session, which is on asset allocation. Before I start, already there are a couple of polls that have already been set. I think the third poll will also go live, and you can quickly attempt the third poll, and then we will start. So the third poll that has gone live, you can quickly attempt that. Okay, meanwhile, as the poll is ready and you quickly attempt it, thank you, Raghav, sir, for giving a very crisp outlook on both equity as well as the fixed income. While markets continue to fluctuate and they remain volatile for a variety of reasons, such fluctuations do impact our portfolio, especially in the short run. And such volatility or fluctuation also impact our mind, and many a times we have found that, people actually exit from the investments quite prematurely without waiting for the investments to actually help them achieve their financial goals. So one way to tackle the fluctuations and the subsequent impact on our mind is to do what is called as an asset allocation. Okay, so let me start the topic with a story. This is the story of a gentleman by the name of Amit. Now, Amit is a daily wage earner, and he earns, say, 500 rupees every day. And he travels every day by bus to his office. And you can look at the image and see the kind of travel that he has to face every day. There are only private service operators who actually run the bus service there, and the frequency is very low. So all the buses are absolutely jam-packed. And you can find that there's absolutely no space, for people to even move. Because of which, what has happened is, some smart pickpocketers have started doing a killing on this route. Okay. Now, Amit is worried because he's earning 500 rupees and he gets it in the form of cash every day, which he happily brings home. But he's worried that someday his pocket might get picked. And if he loses that 500 rupees, which is his hard-earned money, there's a lot of problem that his family has to face. So he goes and consults his colleague. His colleague gives him a suggestion, a very simple suggestion. He says that every day of the 500 rupees that you get it changed into smaller denominations. I mean, हिंदी में बोलते हैं ना चुट्टा कर लो. So you do the chutta, so you convert that 500 into denominations of, say, 100 and 200. Importantly, keep 100 or 200 in the left side pant pocket, another 100, 200 in the right side pant pocket, and maybe 100 rupees on in the shirt pocket. So you distribute that 500 rupees across different pockets. Now, why this is important? Because even if you get picked, one of the pocket gets picked, you end up losing only a fraction of the money. instead of the entire 500 that you would lose if you do not distribute it. So Amit is very fascinated. He looks, wow, this is a fantastic idea. And he starts implementing this idea from the next day. And guess what? He is more relaxed. Now his journey is very peaceful. He does not have to worry too much about the pickpocketers. Now this story is what we normally call as the asset allocation. Right? So what is asset allocation? Very simple. You distribute your investments across different asset classes. Now, if I have to distribute across different asset classes, which are those asset classes, or what type of asset classes should I look at? For that, let me talk about Lord Shiva's family. Now, I want all of you to visualize. इसको आप सोच के देखिए, जो भी मैं आपको बताता हूँ. All of you can visualize Lord Shiva, okay? And if you look at Lord Shiva, you will find that he has got a moon on his head. उनके सर पे चांद है. And the moon is supposed to contain elixir or amrit. But what does he like to drink? He has got amrit with him, but he likes to drink alahal, which is poison. Contradictory, right? Similarly, he has got a snake around his neck. He has got a son, Ganesha, whose vehicle is a mushak. And all of us know that a snake can eat a mouse. So ideally, जहाँ पे सांप होना चाहिए, होता है, तो वहाँ पे मूषक या माउस दिखना नहीं चाहिए. But in this family, you find both of them are existing together. Another incident, Karthik, his second son, he has got peacock as his vehicle. And the peacock can also eat a snake. So ideally, where there's a peacock, you should not find a snake. But in this family, you find both of them. Third, Lord Shiva has got a vehicle which is Nandi, which is a bull, which is a male version of the cow. And a cow is typically considered to be very peaceful, non-aggressive. हम बोलते हैं ना, ये बेचारा गाय है. So that's the kind of behavior that a cow. So you can just extrapolate and assume that the bull also has a similar kind of feature. His wife, Parvati, you will typically find, you will find a lion or a tiger with her. So a lion or the tiger is very aggressive and it can actually eat that bull. Now look at the entire family. So much of contradictions, so much of creatures with opposite behaviors. And ideally, they cannot stay in the same family. But in this family, you find all of them are staying together and all of them are happy. So what do we learn from this illustration is that when we talk of assets, what kind of assets should I have in my portfolio? I also need to have assets which are opposite to each other. If I have all the assets which move in the same direction, then at one point in time, I will be very happy in my life because of my portfolio. On the other hand, I will actually have suicidal tendencies. So if I have assets which move in opposite directions, I will be able to balance my portfolio. And that's very, very critical and important in asset allocation. Okay. Now, what kind of assets do I typically can hold? So just a quick illustration here. Equity markets, most of us generally tend to invest in equities and we miss out on the debt part. Now, just to look at some of the data points, whenever markets have corrected significantly, say for example, the 2008 global financial crisis, market actually came down by 51%. So my 100 rupees would have become 49 rupees. If I would have had some component of debt in my portfolio, that same year, debt has given 27% returns. So typically we find equity and debt tend to go in opposite direction, especially when markets are falling. Some amount of positive returns from debt will help you to cushion your portfolio. That's the essence of asset allocation. So I will explain some more in detail, with some more data points. But essentially what I'm trying to say is, look at the Shiva family, look at assets which tend to move in opposite direction. So let's now look at what kind of assets I can actually invest into. So typically we find there are 4 asset classes. If I were to mix and broadly sort of look at the 4 assets, we have equity, we have debt, we have gold, and we have real estate. Out of which real estate is an investment or an asset class which requires a huge amount of capital. And please remember, when we talk of real estate as an asset class, it's your investment. It's not the property in which you are staying. So the self-occupied property does not become an investment. So for the majority of investors, real estate could be difficult. So which are those 3 asset classes which any investor can easily get into? Those are equity, debt, and gold. And my sincere request and suggestion is we should take an exposure to all these three asset classes at least. All the asset classes have their own features, their own advantages and disadvantages, and their own characteristics. Okay. Now, what do I look at from an asset mix? So I know that I want to get into equity, I want to get into debt, I want to get into gold. But what proportion? How do I decide how much should I invest in equity, debt, and gold? For that, let's look at it from a cricket example. Let's assume that you're coach of a cricket team and you have to select 11 players for the match. What will be the mix of players that you will choose? Simple. You need a batsman, you need bowlers, and importantly, you also need a wicket keeper. So many a times people ignore wicket keepers. Okay, even though I may need only one wicket keeper, but that wicket keeper is very, very important and crucial for the composition of the team. Okay, so I need batsmen, I need bowlers, I need wicket keeper. How much is dependent on the type of the format that you're playing. So if you're playing a test match, you need specialist players. And therefore, my composition could be, I will go with a 5 specialist batsmen. I may have 4 bowlers. I may have an all-rounder, and I need 1 wicket keeper. But if I'm playing a one-day international match or a T20 match, I need people who are multi-dimensional, multi-skilled. So I may go with 4 batsmen, 4 bowlers, add a couple of all-rounders, and have a wicketkeeper. So essentially, the format that I play determines my asset allocation or the mix of assets. Now let's extrapolate this to investments. Okay, we have already discussed what are the 3 key assets that each one of us can look at and must look at. So what mix should I look at? Now those are dependent on 3 important parameters. First is the risk appetite. What kind of risk can you take? Okay, 2 is the liquidity requirement. 3 is what is the investment time frame. So longer the time frame, which is longer the investment time period, the more aggressive assets you can include in your asset classes. If you need money quickly in the short term, you will have to look at investments like debt, or liquid assets, which can quickly get converted into cash. And then we have on the basis of risk appetite. Now, since we are coming to risk appetite, I will have the 4th poll, which is opened up. And I will give you a minute to quickly respond to that poll. So please take a minute out and attend the 4th poll, which will be there on your screen now. And then we will continue. Meanwhile, let me check your scores that you have done in the previous polls. Okay, so the first poll which I put was the recent price to earning for Nifty, which was there during Raghav sir's presentation. So one good thing is that many of you have responded. That's a very, very good sign. That you have been participative right through. That's fantastic. I must really appreciate all of you, and thank you for the time that you've taken to even participate in these polls. I can see even from the asset allocation perspective, as expected, we have a mix of people who have had equities, debt, and again, as expected, few percentages who have got all the 3 asset classes, and that's precisely what we're going to discuss today. Great. Great. I think fantastic. Even on the risk profile, I see that very few people have taken conservative. Okay, that's fantastic, interesting. So most of you are aggressive and moderate. Okay, so I will go with what you have said. Okay, and without getting into more specifics. So risk appetite. So if I want to look at from a risk appetite perspective, how do I do the asset allocation? So I will go by what you have put. If you're an aggressive, I will go by what you have said. But I will just want to put a caution here that most of us feel that I'm an aggressive investor. Okay. So there's again a scientific way to get this done, but because of paucity of time and since we are doing it on a virtual platform, I'm not getting that done. Otherwise, we can actually get individual scores and plot and see how do we fare in terms of the asset or the risk appetite. One caution is that many a times हमको लगता है कि यार मैं तो 6.5 feet का हूँ, so I'm 6.5 feet, macho personality. I'm very aggressive by nature. Does not necessarily mean I am aggressive when it comes to investments. Okay. Similarly, if I find somebody who is very, very shy, timid, they might actually be very aggressive investors. So don't go by your personality trait, but I will take what you have said now. So majority of you have said it, you're either aggressive or moderate. Very few have said you're conservative. So what is the kind of asset split that you need to have is there on your screen. So since you're an aggressive investor, you can have a higher proportion to an aggressive asset class, which is equity. Obviously, you need debt and gold. So we have 15% debt, 10% gold. On the other extreme, if you go to conservative, you will find that the entire asset mix changes. You will have 75% into debt and then 10-15% into debt and gold. If you're the moderate, you have an equal mix between aggressive and non-aggressive, which is equity and debt, with a 10% exposure to gold. And I'm sure that many of your questions, would be on this particular slide. When I was going through some of the questions, I found that many of you had asked questions pertaining to what kind of asset mix is what I need to look at. I think this slide will explain to a large extent and give you the solution to your question. Okay, let's go ahead and see. We have already discussed asset mix, what kind of asset mix, why asset allocation in the first place. Some of the examples and illustrations we already looked at, but few more data points. First is the assets that we looked at, these assets perform at different periods of time. Okay. Two, there's the most important element of asset allocation is reducing the risk and giving you that peace of mind. I said markets will be volatile in the short term, and volatility brings a different kind of behavior in us. Okay, it makes us more restless. But when you do asset allocation, you will actually have a peace of mind. Third, scientifically, it has been proven that asset allocation is one of the most critical element when it comes to wealth creation. And Raghav has also alluded his own personal example of investing for the last 20 years. And that is one of the most important mantras for wealth creation. Asset allocation is very, very important. Now, I said that different asset classes behave differently. This is a quick slide, which talks about the calendar year returns of the three asset classes: equity, debt, and gold. And if you were to look at this particular table, you will find that you have a range of returns, across all the three asset classes. And more importantly, there is no one asset class which is number one for all the years. ऐसा कोई भी asset class नहीं है जो हर साल number one आया है. Okay, so let me give you what is the significance of this table. Out of 20 years, 10 years, equity has been number one, as expected. Gold has been number one for 5 years. Debt has been number one for 3 years. And debt and gold jointly have been number one for 2 years. So no asset class is number one each and every year. Okay. Now let's look at another interesting aspect. So the average returns of all the asset classes over the 20 years is there on the screen. Obviously, equity shines with almost 19%. Debt is more conservative, obviously, so the returns are almost 10%. Gold has delivered better returns than debt. Look at the second row, which is the standard deviation. So all of us know intuitively that equity is the best asset class, but equity also happens to be the most volatile. What is standard deviation? It is basically telling me what is the range of fluctuations that can happen in returns. And equity has the highest fluctuation. So it's like a batsman, So if a batsman scores 100 in the first inning, second, third, fourth inning, he scores 0, 2, and 5 runs. And then in the fifth inning, he again scores 100 runs. So totally he has scored almost 205 runs in 5 innings. Average is almost 41. But what is the consistency? Very poor. I may have another batsman who scores, 40, 50, 35, 60, 45. So this batsman is more consistent. Average may be very close to what the first batsman also had, or less than that. But importantly, is more consistent. The fluctuations are much lower. And this is what you see in this slide. Equity has the highest fluctuation. Debt has the least fluctuation. And therefore, it becomes important to be a part of our asset mix. Gold is less volatile than equity. Okay, and gold generally tends to do well, especially when there is a lot of uncertainty in the market. So a quick example, last year when the markets came crashing down by 37% because of COVID, suddenly people started moving towards gold. And this is what typically happens with gold as an asset class, because it's considered to be a safe haven. So people start buying the gold prices appreciate. And therefore, gold is also an important element in our asset mix. Now let's look at the correlation. Go back to the illustration of Lord Shiva. we said that we need to have asset classes which move in opposite directions. So equity and debt have got a negative correlation of 0.5, which is very, very critical, because the essence of asset allocation is to minimize your risk by diversifying it across asset classes. Gold and equity have very, very limited or almost negligible correlation. So by having asset classes which move in opposite directions or which have very low correlation, you create the right mix and the right balance of assets in your portfolio. That's very, very important and critical. If I have all equity, so a lot of people say, I've got large cap, mid cap, small cap, I also have a flexi cap. I have diversified. Yes, you have diversified, but within the same asset class. So everything goes up, you also enjoy. Everything falls, problem. So you have a mix of debt, you also have a mix of gold. We have already discussed what should be the right mix. Okay. Now, just to sort of extrapolate this, if instead of 100 rupees in equities, I would have done a portfolio asset allocation. I have created two portfolios. One is P1, the other is P2. P1 is a portfolio which has got 65% equity, 20% debt, and 15% gold. P2 has got 70% equity, 20% debt, and 10% gold. Look at 2011. Equity fell by 24%. So my 100 rupees would have become 76. Had I followed asset allocation, look at P1 and P2 portfolios, my performance in P1 would have been almost 90 rupees. P2 would have been almost 88 rupees. So obviously 88 and 90 is much better than 76. And this is the reason why we need to do asset allocation, because the portfolio looks much rounded, much balanced, and the tendency for people to exit from investments is much lower as compared to when you have only pure 100% equity, and especially when the market corrects significantly. Okay. Now, how do I take the exposure? So we have learned about different assets, but how do I take the exposure? Very simple. The fortunate part is that mutual fund offers you all the three asset classes. So you have an equity fund, you have a debt fund, and you have a gold fund. So, okay, so gold you can take through ETF or through a gold fund. All of you know about different types of equity funds and different types of debt funds. We're not going to get into that. Okay. Now, there are two different types of asset allocation practices that I can do. First is the strategic asset allocation. The other is tactical asset allocation. Now, what do I mean by strategic asset allocation? Strategic is more long-term in nature, and typically you link it to your goals. Say, for example, I want to plan for my retirement, and let us assume that's going to be 15 years down the line. And I decide that I will invest 70% in equities, 30% in debt. Okay. The important thing in strategic asset allocation is that you maintain the proportion of equity and debt. So I will continue to have 70% in equity, 30% in debt, which means I will rebalance my portfolio. And this can be done generally once in a year, or you can even do it once in 2 years. There's no hard and fast rule that I have to do it every year. But typically, at least in a 1 or 2 year period, I will try and maintain the same proportion, which is 70-30 or whatever you decide. So that's the strategic asset allocation, which is long-term in nature. And typically, when you invest for your goals, this is what is recommended. There's another type of asset allocation, which is more tactical in nature, which is short-term oriented. This is something which is, I want to take advantage of certain events in the market. This is a tactical asset allocation. So what do I do here? I will change my asset allocation depending on my expectation. So for example, if I feel that equity market is going to do well in the next 3 to 6 months, so all the indicators are very positive. GDP is doing well, corporate profitabilities have also come well. I expect markets to go up. I will allocate a higher proportion to equity to take advantage of the perceived anticipated bull run. And once that bull run happens, I will rebalance and come back to equity and debt again. Similarly, I can do it in debt. If I expect that RBI is going to aggressively cut the interest rates, then I may want to take the advantage of this possible movement. So I may get into long duration funds, or I may get into a gilt mutual fund. And as and when that event gets over, then I will again come out of those investments and realign my portfolio. So tactical is more to be done on a more frequent basis, reviewed and revised. And typically this is done by people who understand the market and done by sophisticated investors. But for the majority of retail investors, strategic asset allocation works very well. For high net worth individuals, people who are very good at markets, they can look at tactical asset allocation. Okay. So finally, there's one more product, which instead of I taking an exposure into equity funds, debt funds, and gold funds, there's a way of doing all of them through a single fund, which is there even on the Axis table, which is an Axis Triple Advantage Fund. So this is the fund which will invest in all the three asset class, equity, gold, and debt. The proportions will vary. 65 to 80% will be in equity, 10 to 30% will be both in debt and gold. So this is one product which gives you the benefit of investing in all the three asset classes without having to invest differently in different asset classes. Okay, so this is one product which you can definitely look at. This is the hybrid product. And because you have got a significant proportion of equity exposure, you will find that the risk parameter is also very high. But this is a fund you can definitely look at if you're looking at creating wealth over a 10, 15, 20-year period. Some of your financial goals can get linked, and you can actually try and accumulate the corpus that is required through this particular fund, right? So I think we will pause here. And we have got few questions which we'll try and take if we have got time. I think most of the questions, during the presentation we would have tried to cover, but yes, we will definitely look at some of the questions. So we will also have Raghav, so he'll try and address some of the questions without extending the time too much. So whatever limited questions we can take, we will take. So just give me a moment. Let me just go to the question set and find out. Okay. Raghav sir, there's a question which basically talks about one of the recent RBI comment that there's a bubble in the equity market. So should I look at booking profits, and how should the retail investors allocate their portfolio?
I don't know when that RBI comment was made, but see, I think, as I said, markets are dynamic. Remember my walk in the park example. If you have a goal and you kept some money for that goal, let that goal get realized. I am a believer that one should stay invested. I am a strategic asset allocator, not a tactical asset allocator. If you are a tactical asset allocator, obviously you're looking at this 51,000 index and maybe feeling that it's time to get up. But as I had mentioned in my previous slides, economy seems to be doing all right. Vaccination is definitely increasing. Economic activity will increase. Global economies are doing well. So obviously that pertains to a reasonably good chance of a economic recovery. Where there is good economic recovery, obviously equity markets will follow. But remember my dog in the park example, sometimes markets get a little ahead of themselves, sometimes they get back. Most of us are not experts in timing this time. So I think I would stay invested. Like I said, be invested in a dynamic asset allocation fund. Let an expert take a call whether he should be 60% or 65% equity or 75% equity. That's fine. Of course, if you are an expert, yes, it's a call, but frankly, predicting over the next 1 year is practically impossible.
Right. There's one more question which is on the basically a view on where do you see Nifty and Sensex at the end of financial year 22? How do you see the earnings grow, and do you see the price to earning cooling from the current levels?
I think, see, price to earnings will cool because, again, as I said, earnings will improve. And obviously, as I said, markets are always a little ahead. Markets, as a very famous investor put, in the short term, are a counting machine. In the long term, they are a weighing machine, right? So ultimately, the companies that you invest in, if they do well by all financial parameters, the stock price either catches up or would have already gone up to that extent. So a lot of today's market may already be expecting a reasonably big economic recovery happening because of the turnaround in the vaccine and the other things that I spoke about. But so predicting something in 22 is very, very, very difficult because frankly, today, one, we are in a very, very integrated global world. Number two, I think 3 months back, if I had stuck my neck out and said everything is absolutely fine, you saw what happened in the month of April. Right? You went from a caseload of like under 10,000 cases a day nationally to almost about 5 lakh cases a day. Almost. So that's how quickly things can change in life. So my belief, again, be strategic, don't be tactical. Set a set of goals. Allocate some money either individually to debt funds, equity funds, and gold, or if you don't have the time and you have better things to do with it, like I have right now talking to all of you, I would just put my money into a dynamic asset allocation fund and let a professional take care of it.
Okay, great. There's one question on the asset allocation. I will try and address this. The question is, what percentage of blue chip, mid cap or small cap should one take? How much gold should be taken? This is a query from a retired person without pension and active income. Okay. So if my suggestion is that if you don't have an active income, and that's precisely, that's I think the first priority for you to look at investing from the objective of generating some regular income to take care of your expenses. So the normal suggestion is, since you are a retiree, the normal suggestion is that you invest a lump sum into a debt mutual fund. You can look at a very simple fund like a banking PSU fund or even a short-term fund, and do what is called as a systematic withdrawal plan to take care of your monthly expenses. Alternately, you can also get into the hybrid space. You can look at a conservative hybrid kind of fund, which is a fund which invests about 70-90% into 75 to 90% into debt, and only about 10 to 25% into equity. So you get a mix of both debt and equities. Debt is a very high proportion, so that's why it's a conservative hybrid fund. And again, from there you can do a systematic withdrawal plan. I would not recommend you to invest directly into any of the equity funds, because you're retired and you have no active source of income. Okay, so I think that that should be the answer for your question. Raghav sir, there's another question. Which type of international fund should one invest? Should we look at US, China, or the global index fund?
It's a lovely question, because I think at Axis we have been actually in the forefront of bringing international funds to our retail investors. It's a beautiful thing that you're asking me, because Indian investors are actually have a very strong home bias. There is a home bias. By home bias, I mean Indian investors investing in their home markets. Indian investors are 99% plus invested in homes. So number one, yes, you must have some external investments. That's more from a fact that you get access to some companies which are not available in Indian markets. Again, whether one should invest, I am again in that sense a little more conservative. I prefer to put money into a international diversified fund which diversifies across companies, across geographies. If you are an astute investor, then yes, I think a country-specific fund will suit you, because then obviously you need to know much more about that country, its stock market, its economic prospects, for you to take a decision on whether to put in China or US or Europe and all that. And remember, you need to be very astute at it. Just a little bit of reading or seeing a few Facebook posts or just subscribing to a few investment blogs does not make you an expert. Does not make you an expert. Let's be very clear about that. I think there are enough people who do put in substantial hours of work to get to an investment decision. Just by doing a 10-minute blog read or even listening to a few experts on TV doesn't make you the expert. So I would be more inclined to put money into a global diversified equity fund at this time. Yes.
Absolutely. Great. There's one question which is again related to asset allocation. I will try and take this one. Why to invest in gold, and how should I invest through mutual fund or ETF or mining shares or bonds? Okay, so as we discussed, the gold is a very important asset class. One, because it is considered as a safe haven, especially when markets correct significantly. We discussed, even if you look at last year, COVID, markets corrected, we saw significant rally in gold prices. So from a diversification perspective, we need to allocate to gold. And also, as I discussed in the presentation, gold has a lower volatility as compared to equities. So from a diversification perspective, yes, one needs to invest. How do I invest? Frankly, I think it is dependent on what is your requirement. So for example, if you need liquidity, okay, then an ETF is a much better option, or a gold savings fund is a much better option. In the case of sovereign gold bonds, if that is the one that you are referring to, there is a maturity of 8 years, if I'm correct, and there's a lock-in of 5 years. So liquidity is an issue with the sovereign gold bonds, even though you get an interest income that is paid annually. But please also remember that the interest is taxable. Okay, and when you exit from the sovereign gold bond, if you exit, there's a capital gain tax also to be paid. Only when you exit at maturity, there is no tax. If you have a demat account and you can buy minimum of the units, which typically is 1 gram of gold, then ETF is a better option. If you do not have a demat account, and if you do not want to put or invest money up to 1 gram, then you can look at a gold savings fund, which is a gold fund, which is what it is commonly referred to. Mining shares typically will do well basis the underlying is different. If the ETF and the mutual fund typically gets the pricing from the price of the asset, which is the gold. Mining shares will do well when the company which are into mining, they do well. So if their profitability is well, if the companies do well, then you will also get a good appreciation in the shares through mining companies. So I think that addresses your question. I think, sir, we can take a couple of questions, or we want to stop at one. It's 11:35. So one fun question, it's a very interesting question, which
I
says
think we
that...
should take one more, and
Okay.
let's take one more, because it's a Saturday morning. We should not intrude on people's.
Yeah. So we'll take the last question, which is to do with how do you ensure Axis funds perform in a market crash, and how can you reduce the losses? I think, again, a very interesting question.
That's a lovely question. I think Axis philosophy has been always trying to buy, identifying high quality, high growth, high sustainability, and what we call finding companies who are constant compounders, right? So I think for a company to get into our universe is reasonably tough. It has to fit a fair amount of strict criteria. And these companies tend to do very well in a market crash, because obviously, like how Hari mentioned, in a market crash due to volatility, people tend to go towards so-called safer asset classes. These are the more established, well-recognized names who have a very good track record of managing in a time of crisis, and in fact, actually taking opportunity from crisis. So most of the investors then tend to take out and put it here, and that obviously leads to a lower price fall as compared. And it, in some sense, it's statistically proved last year, if you were to look at how we did during the crash. Like, it has also helped us because it's obviously given us we have a 10-year track record in some of our key funds. And if you just look at the way our funds have performed in that period, markets have gone through enormous number of cycles, and you will understand what it will factually show you what I'm trying to say over there. But yes, I think the important thing, and I like to conclude with this, is to please stay the course. Don't get carried away by fear and noise. Definitely don't get carried away by WhatsApp University. You have to decide what type of an investor you are. There are no hard and fast rules as far as investing is concerned. The 65-70% that Hari talked about is just an example. Look at those three parameters. They're very, very critical from an asset allocation perspective, which is your risk, which is your duration of time, and then more importantly is liquidity. All three are very important. We tend to look at risk very closely. We forget about liquidity, and we forget about the timing aspect. Don't put money into equity unless you can stomach a loss. That's important. Forget about the last 1.5 years. We're seeing a lot of investors coming into equity. I'm very happy personally, because I am a firm believer that equity is a very important part of wealth creation. But please understand the risks before you take a big investment. And obviously, please try and avoid being tactical, because I can only share from experience. Being tactical makes you feel short-term happy, but yeah, if you don't do it, it gives you a lot of pain. And ultimately, we invest for two things. We invest to satisfy our goals, to meet our goals, whatever they are. And more importantly, we invest for peace of mind. Sometimes tactical asset allocation does give you, take away a little bit of that peace of mind. So be a strategic investor. If you can't do it, just give the money to a dynamic asset fund and let an expert fund manager do that for you. Give him time to perform, give him a few market cycles to perform, see his track record, and trust me, you'll have a fantastic job. So yes, thank you. On that note, I hope this session, the last 65-70 minutes, have been useful to all of you. We got a lot of questions. In the interest of time, we were able to take a few. We hope we've been able to address a few of it. We really enjoy having these conversations with you. And we look forward to any feedback that you could give us to make this a better and more fulfilling experience for both of us here. Thank you very much. Thanks, Hari. Thanks to the team that's organized this. And have a lovely weekend. And please stay safe, stay happy, be well, and invest well. That's a good motto to be. Yes. Thank you again.
Thanks. I'll take over to you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.